Welcome to the Explainer. All right, let's get right into it. Today, we're cracking open a document that, even though it's from 2006, is packed with lessons that are maybe more relevant than ever for today's professional investor, Warren Buffett's annual letter. We're going to distill that timeless wisdom into a practical masterclass.
Okay, let's just kick things off with a number that, honestly, it looks like a typo, right? 361,156%. Let that sink in for a second. That's the overall gain in book value per share for Berkshire Hathaway from 1964 to 2006. I mean, it's just a ridiculous figure.
But, and this is classic Buffett, he's the first one to tell you that one mind-blowing number doesn't even begin to tell the real story. For anyone who's serious about this stuff, you know the real gold isn't in the headline number. It's in the why, the principles and the thinking behind that performance. And that is exactly what we're here to unpack.
So to really get at that core thinking, we've basically pulled out 5 key masterclass lessons from this one letter. We're going to look at the metrics he actually uses, how Berkshire became the buyer of choice. We'll talk about the magic of insurance flow, his, let's call it an antidote to Wall Street, and finally, his search for a successor. Okay, Lesson 1, Buffett's True North Metrics. This gets right to the heart of his analytical approach. It's all about looking past the obvious stuff to see what's really driving the value. And honestly, this little shift in perspective, it can change how you look at pretty much any company.
So you know how everyone obsesses over per-share book value, right? Well, Buffett kind of pushes that to the side and says, look here instead. He gives us 2 other yardsticks that are way more telling. First, the per-share value of their investments, and second, the per-share pre-tax earnings from their non-insurance businesses. And these aren't just random numbers. This is a deliberate choice to show you the 2 engines driving the whole machine.
And here's why that distinction is so critical. You can see the result of a massive strategic pivot right here. Look, as Berkshire got bigger and bigger, finding those cheap, undervalued stocks got a lot harder. So the growth from that investment engine started to slow down. What did Buffett do? He shifted gears. He started buying entire businesses outright, and you see the result in the earnings growth. I mean, it's a perfect lesson in how you have to adapt your capital allocation as you scale.
All right, on to Lesson 2, becoming the buyer of choice. And this is all about an asset that, well, you're never going to find it on a balance sheet, but it just might be Berkshire's most powerful competitive moat. We're talking about reputation.
You see, Buffett very deliberately built this reputation as the anti-acquirer. He positioned Berkshire as the one place a family business founder could sell to and know would have a permanent, stable home. It's not going to get flipped by private equity in 3 years or dismantled by a strategic buyer. And this isn't just, good PR. It's a core business strategy that gets him a look at deals that nobody else even knows are for sale.
The TT acquisition is the perfect case study. You have the founder, Paul Andrews, who's worried about his company's legacy. What happens after he's gone? He looks at the usual options, a strategic buyer who'll just gut the place, or a PE firm that'll load it with debt and flip it, and he says, no thanks. So what does he do? He calls up Warren Buffett. They meet in the morning, and by lunchtime, they have a handshake deal. No auction, no bidding war, just a conversation.
I mean, you can feel it in this quote from the founder, can't you? It's all about confidence and trust. That's the moat. That's what lets Berkshire completely sidestep those brutal, competitive auction processes for great businesses. They get a phone call that no one else gets.
And by 2006, this wasn't just a US thing anymore. This unique advantage went global. When they bought ISCAR, a huge Israeli company, it was a massive signal. It showed that Buffett's reputation as the ultimate long-term owner was now a global asset, which, just dramatically opened up his field of play.
Okay, Lesson 3, this is a big one. We're going to talk about the magic of insurance float. Now, this is a term that pretty much every investor has heard, but I think very few really appreciate just how powerful this engine is at the heart of Berkshire.
And leave it to Buffett to define it perfectly. Float is basically other people's money that you get to hold on to. It's the cash you collect from insurance premiums that you get to invest for yourself before you have to pay out any claims. So at its worst, it's like a giant interest-free loan. But as we're about to see, it can get a whole lot better than that.
Just look at the sheer scale of the growth here. It's insane. From $17 million back in 1967 to almost $51 billion by 2006. This massive, always growing pool of capital, this is the jet fuel for all of Buffett's big acquisitions and stock market investments.
So here's where the real magic happens. It's not just about having the float. The trick is to generate it profitably. If the money you earn by investing the float is more than what you eventually pay out in claims, well, then the float isn't just free money to borrow. You are literally being paid to hold and invest billions of dollars. It's financial alchemy, and almost nobody does it as well as Berkshire.
Lesson 4. Let's call this one an antidote to Wall Street. This is where Buffett takes on the whole financial industry's obsession with complexity and crazy fees. It's really a powerful case for just doing things simply and with integrity.
So he creates this great contrast. On one side, you have what he calls the hyper-helpers. You know who he's talking about, the 2 and 20 crowd, with these incredibly complex black box strategies that come with huge fees. And on the other side, you have his friend Walter Schloss, whose entire strategy could be summed up as, we try to buy stocks cheap. I mean, it's the perfect illustration of complexity that helps the manager versus simplicity that helps the investor.
And the proof is in the pudding. Schloss's record is just a huge refutation of this idea that you need to be complex to be sophisticated. The guy ran a partnership for 47 years, never went to business school, just used simple ideas he learned from Ben Graham, and absolutely crushed the S&P 500. And here's the kicker. He only got paid if his investors actually made money. It's just a powerful reminder that alignment and a simple, sound approach will beat complexity 9 times out of 10.
And that brings us to our final lesson, and it's a big one. The search for a successor. This is the ultimate question for any company built around a visionary, right? What happens next? It's a huge risk factor, and Buffett, to his credit, tackles it directly.
And in his classic, candid style, Buffett just comes right out and says it. They had a gap in the plan. Back in '06, he felt good about the CEO succession, but the really crucial job, the chief investment officer, the person who would manage all that money, that role was wide open. He was actively looking for someone younger to eventually take the reins of that massive portfolio.
So what was he looking for? The job description he lays out here is absolutely fascinating. Notice what's not on the list. He's not looking for the person with the highest IQ or some hotshot manager with a great 3-year track record. The focus is 100% on temperament. He wants someone who is, quote, genetically programmed to avoid big risks. Someone who thinks for themselves, is emotionally stable, and really gets the weird ways humans and institutions behave.
And that really leaves us with a final, pretty provocative thought for anyone in this business. Buffett's whole point is that intelligence in the world of investing is basically a commodity. It's everywhere. But the right temperament, that is incredibly rare. So it makes you wonder, in a market that is just packed with smart people, what really separates the winners from the losers? How much of it comes down not to what's in your head, but to how you behave? Something to think about.